All right, let's just dive right into this. Welcome to this explainer, where we're going to completely bypass the noise and look directly at the actual mechanics shaping our financial world. Every single day, we're bombarded with these flashy headlines, right? AI bubbles, whatever drama is happening in Washington, the Federal Reserve's latest press conference. But honestly, those are just the tip of the iceberg. What we're unpacking today are the massive, unseen structural forces that are driving the markets from beneath the surface. So let's map out exactly what's happening. So I've got to pose this question directly to you. What do you think is the biggest threat to the U.S. economy today? It's totally natural to just assume it's tech bubbles or political gridlock, but the real danger isn't any of those things. The real threat is actually hiding completely in plain sight, and it's something you might never have even paid attention to. Let's start with part one, hiding in plain sight. For roughly 30 years now, Japan has quietly served as the financial duct tape holding the entire global system together. And to understand why, we have to look back at 1992. When their massive asset bubble burst, it kicked off what they call the lost decades of economic stagnation. To fight this, their central bank literally superglued interest rates to the floor. They cut rates to zero, then they went below zero, and finally they introduced this thing called yield curve control, explicitly capping long-term bond yields. Now picture this. Imagine you're a Japanese pension fund. You've got $1 billion to invest, but your domestic bonds pay, well, literally 0%. You have absolutely no choice but to go on a global shopping spree just to find some kind of return. Because of this dynamic, Japan quietly transformed into the world's borrowing machine. They became the largest foreign holder of U.S. treasuries and effectively the entire world's ATM. The mechanics of this are just brilliantly simple. It's what's known as the classic yen carry trade. Here's how it works. You borrow yen for basically nothing at near zero interest. You convert that over to U.S. dollars. You buy U.S. treasuries that are yielding somewhere around 4%, and boom, you just pocket the spread. This multi-trillion-dollar math trick became a massive automatic pipeline of cheap liquidity that funded global tech stocks and real estate for decades. But here's the catch. This entire global machine relied on one incredibly fragile assumption, that Japanese rates would just stay near zero forever. Well, in 2024, that assumption totally broke. The Bank of Japan finally ended yield curve control. They raised rates, and the market reaction? It was violent. Following their second rate hike, the S&P 500 dropped 6%, and Japan's Nikkei index plummeted over 12% in a single day. There's no sugarcoating it. The markets were officially spooked. Because think about what happens when Japanese yields rise. The math violently flips. Suddenly, borrowing in yen is really expensive. The cost of hedging your currency risk absolutely spikes. And that free money treasury spread, it just vanishes. Consequently, this massive wave of capital that flowed out of Japan for decades is reversing course and heading back home. The era of incredibly cheap automatic global liquidity is ending right before our eyes. To really hammer home why this matters so much, listen to what legendary investor Ray Dalio has to say. He calls the bond market the backbone of all markets. Everybody hyperanalyzes Jerome Powell and the Federal Reserve, right? But the Fed really only controls short-term rates. The long-term yields, the ones that actually determine global wealth and asset returns, those are driven by basic supply and demand. And here is exactly how this connects directly to your wallet. If Japan, the absolute most consistent buyer of U.S. debt, stops buying, will long-term yields have to stay high to attract new investors? This means steepening yield curves, compressed stock valuations, and tightened corporate credit. If you've been sitting there wondering why your mortgage rate won't just magically drop back to 3% even if the Fed cuts rates, yeah, this is exactly why. The world's biggest buyer just took a step back. Which brings us to part two, inside the SpaceX illusion. So while global liquidity is drying up on one end, the market is artificially engineering demand on the other. Take SpaceX, for example. They are reportedly targeting an initial public offering valuation of $1.75 trillion. Just let that sink in. At that price tag, they would be worth more than every single American defense contractor. Coca-Cola, McDonald's, Disney, Nike, and Starbucks combined. It's wild. Now, most people think SpaceX is just a cool rocket company going to Mars, but structurally, it is essentially three totally different businesses stacked together in a trench coat. You have Starlink bringing in roughly 61% of the revenue, the famous rocket business sitting at 25%, and then a recently acquired AI lab called XAI. And that AI lab, it is an absolute cash furnace. Let's look at the actual reality here. Starlink is phenomenal. We're talking over $11 billion in revenue with incredible 63% profit margins. The rocket business, also solid, coming in at roughly $4 billion. But then you have XAI, which is burning an estimated $1 billion a month while they literally rebuild it from scratch. You combine all of that, and this nearly $2 trillion company actually lost about $5 billion last year. So you really have to ask yourself, who exactly is going to buy a company losing $5 billion a year at literally the highest valuation in human history? Well, the really uncomfortable answer is you. And it's happening because the financial system is quietly stacking the deck. And that leads us to part 3, rigging the stock market. How exactly is this being orchestrated? Well, back on May 1st, the NASDAQ quietly adopted some rule changes that essentially roll out the red carpet for tech giants. Under the old rules, a company had to trade for 3 months. That gave the market time to do its job and discover the real, fair price. This new fast entry rule, it compresses that period to just 15 days. The market is being denied a proper seasoning period before trillions of dollars in passive funds are legally forced to just buy in. And then there's the free float. The old rules demanded that a minimum 10% of shares be available to the public. It was a vital protection mechanism. The new rule, that minimum has been completely eliminated. 0. It's absolutely perfect for a company like SpaceX, which is only targeting a tiny 4 to 5% float. Under the old rules, they would have been disqualified completely. But hold on, because here is the absolute most deceptive mathematical trick of the whole shebang, a hidden multiplier. Check this out. If a company has a tiny public float, under 20%, index ETFs are legally forced to treat that float as if it were 3 times larger than it actually is. It's an automated structural mechanism to literally manufacture billions in demand for a very tightly controlled supply of stock. Which brings us to our final act, part 4. You are the exit. So we have Japanese liquidity drying up, colliding head-on with rulemakers who are artificially engineering demand. And here's exactly where your wallet comes into play. While a typical IPO usually allocates maybe 5 to 10% of shares to retail buyers, SpaceX is explicitly targeting 30% for everyday investors. The corporate spin is that they are, rewarding fans, but the actual mechanics show them dumping an unusually massive, mathematically inflated asset directly onto the public. Portfolio manager George Noble summarizes this reality perfectly, and it is pretty stark. He says, your 401k is the exit liquidity. Think about it. Early insiders, the venture capitalists, the private founders, they are all looking to cash out at absolute peak valuations. And by changing the index rules, everyday workers and their retirement accounts are basically legally forced to step in and hold the bag. So, to summarize our iceberg today, the foreign ATM over in Japan, it is officially closing. Real global liquidity is tightening. To keep the music playing, financial rulemakers are having to engineer forced demand. The very mechanics of passive index investing, the set-it-and-forget-it strategy that you were told was incredibly safe, will automatically use your retirement funds to absorb the massive risks that all the insiders are shedding. I want to leave you with one final, kind of provocative thought. We've all been sold on the incredible convenience of passive investing, mostly because it buys the market for you automatically, right? But if this explainer has shown you anything today, it's that you really have to ask yourself, who exactly is writing the rules of that market? Keep looking beneath the surface, guys, and I'll see you in the next explainer.